Every week in the markets, we get a flood of economic data releases. GDP, employment, inflation, PMIs, and central bank meeting minutes, just to name a few. And very often, brokers and analysts act like every number is critical. The market's moving, the game's changing, but it's not true. My name's Dave Huggett. I'm a foreign currency consultant, and today I want to show you which data actually matters and which is just noise. Because quite honestly, most of it's noise. You see, not all economic data is created equally. Some moves the market significantly, and some barely registers. And some gets hyped, but actually changes nothing. Here's the hierarchy that actually matters. Tier 1, interest rates and forward guidance from central banks. Tier 2, inflation readings, employment data, and Tier 3, broad economic indicators like PMIs and retail sales. Everything else is Tier 4, and it rarely moves the market unless it's wildly against forecasts, but never really concerns the timeframes that corporate businesses care about. Let's break down why. Interest rates are probably the most important fundamental driver of currencies, and there's not much else that comes close apart from events that we can't predict. Why? Because capital flows to where it gets the best return. If the Bank of England raises rates, but the Fed holds, GBP then becomes more attractive. So money flows to sterling, and sterling strengthens. If the Fed raises and the Bank of England holds, then the opposite happens. This isn't theory. It's observable and repeatable. But here's what often matters more than the rate itself: forward guidance from the relevant central bank. When central banks raise rates, but then signal that they're done raising rates, the market then often sells the currency because the move is priced in. When they hold rates, but signal that more rate hikes are likely, then currencies often rally because the market is forward-looking. For corporate businesses facing foreign currency risk, this means it's more important to pay attention to the central bank meeting minute and not just the rate decision itself. And that means the commentary, the hidden meanings, the often slightly cryptic feedback that the market ends up subsequently trading on. That's the real skill in forecasting future currency moves, because that's where the real information sits. Employment numbers and inflation are Tier 2 because they directly influence what the central banks do with rates. For example, strong employment and high inflation, central banks are more likely to raise rates or hold them higher for longer. But weak employment and low inflation means that rate cuts become more likely. Here are the key employment reports that are released on a monthly basis. In the US, it's non-farm payrolls. In the UK, it's a labour market overview. And in the Eurozone, it's their unemployment rate. Equally, when it comes to inflation, these are the key metrics to watch. US CPI, Consumer Price Index, which is also released monthly, as is UK CPI and Eurozone HICP. You don't need to study every line item, you just need to know the headline number and whether it's above or below expectation. If inflation comes in higher than expected, then currencies usually strengthen as rate hike expectations rise. If unemployment's weaker, then currencies usually weaken because rate cuts are more likely in an attempt to stimulate the market. It's just simple cause and effect. Next, we look at GDP, gross domestic product, which gives us an indication of how well an economy is growing. But it's less important than most people think. Why? Well, GDP is backward looking. It tells you what happened last quarter, not what's happening now. And remember, markets care more about the future than the past. So GDP really only moves currencies if it significantly outperforms expectation or if it misses, because only then does it maybe change the central bank's likely path on interest rates. In summary, a strong GDP kind of confirms what everyone already knew. It's priced in, so likely to have minimal impact. But a weak GDP can raise concerns around recessions and can force central banks to rethink monetary policy, and that can move the market. The same thing applies to PMIs, Purchasing Managers Index. They're forward-looking sentiment indicators, which makes them arguably more useful than GDP. But again, only really meaningful if they massively outperform or underperform expectation. Because if that happens, then we may see a shift in expectation around central bank policy. So what can you safely ignore when looking at your business's foreign exchange decisions? Things like consumer confidence surveys, retail sales, trade balance data, most housing data, political speeches. All of these are fairly irrelevant unless they're extreme or unless they directly announce policy change. I only ever see the market move off this type of data release if they're way outside forecast. And even then, the moves are only typically short term and relatively contained. So here's the critical point. The data only matters if it changes expectations, especially around monetary policy. If the market expects a 2% inflation reading and 2% is posted, nothing happens because it's priced in. But if the market expects 2% and it comes in at 3%, currencies moved because expectation has now changed and the market starts to price it accordingly. And this is why you often see data releases that seem significant but have no effect on the market. Because if the number was expected, then it's already in the price. Remember, markets know everything. So how do you apply all this? Well, you certainly don't need to track every data release. You just need to track the tier 1 and the tier 2 events, because these are the ones that could shift central bank policies. So for GBP exposure, look out for the Bank of England meetings, and especially the following commentary: UK CPI or inflation, and employment data. In the US, we watch the Fed, their meetings and their associated commentary, and again, inflation and non-farm payroll. And for euros, it's the ECB and their meeting minutes, Eurozone inflation, and PMIs from the major economies like Germany and France. When those data releases are coming up, that's when you know the market might spike. And if you're looking at FX decisions that week, then just make sure you factor that in. For example, if you're looking at a forward contract, it may be worth locking that in before the data release itself to protect you from any volatility that might follow. Or if you feel that the data might benefit you and your timeline allows it, and you're not putting your business at risk, maybe you wait till afterwards. This is the strategic use of fundamental data, not for prediction, but for context. If you use this in line with basic technical analysis, then you can give yourself the best chance at the best outcome. Next week, I'm looking at a forward contract reality check, when forwards actually protect value, when they create risk, and most importantly, the benefits around flexibility. If you're a business that's facing international payments and currency risk, and you want to discuss your exposure or how the upcoming data might affect your situation, then book a call in the link below. There's no pressure at all, and we'd be glad to talk it through. And if this video has been useful, please hit like, please subscribe, and thanks for watching.